Ever wonder how a financial professional trades a stock or an ETF when the markets are open? Do you want to know the difference between a market order, a limit order, and a stop order? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about market orders, limit orders, and stop orders, how all these work, and when are they appropriate based on different market cycles or what you're trying to accomplish by being your own trader. Don't forget to hit these like and subscribe buttons down below the screen here if you're so inclined to catch future episodes of The Vault with Doug, Garrett, and myself. And let's go ahead and get to it. Garrett, you've put together a good vault here for people who are looking to understand the world of being their own trader and not relying on advisors to do their trading for them. Let's start off with market orders. What is a market order?
Yeah, so let's dive into the world of being a trader. Today, what we want to do is just cover kind of the three basic standard orders out there. There are some more complicated variations of these, but let's at least cover the three basics. Okay. The first one being the market order. Okay. So in a market order, much like the name implies, this is when you want to buy or sell a stock, could also be an ETF or a mutual fund, by the way, at the market's best available price to you right then, right there. So this order is best used under two conditions. One, you think that the stock or mutual fund is priced right and you want immediate execution. Two, we need to make sure that the market is actually open and actively trading. It is possible to place a market order after hours when the market is closed. The risk that you run there, though, is that essentially it's going to look back and say, okay, what did this stock close at from the previous day? And it's going to essentially, as soon as the market opens the next day, execute your order. Well, in after-hours trading, there can be significant volatility, either up or down, and that might be out of your price point that the trader originally wanted. So market order, most common order, what is it good for? You want the market's best available price right then and there, and you want in the market action right then and there, whether you're buying or selling.
The easiest, most basic of all the orders, like going to a grocery store and just buying something off the shelf, whatever price they've got on it right then and there is what you're paying for it.
And you would basically just to use a quick example, I want 10 shares of Ford Motor Company at the market price. Okay. Done. Executed.
Very good. But best off to do that when the market is open so you know exactly that the price that you're getting. As you said, you place it after hours as soon as the market opens. That price might have dropped or gone up.
Gone way up.
Went down. Great. Good on you. Went up. I was expecting to buy these shares at this price. Why did I buy them at this price? And you've got some explaining to do.
Exactly. There you go. Yep.
Very good. All right. So then let's move on to slightly more complex ones. What do we have as far as a limit order? What is a limit order?
Okay. So the whole purpose of a limit order is essentially what you want is you want to have a restriction on the maximum price that you're going to pay with a buy limit order, or a minimum price to be received with a sell limit order. So let's kind of talk through that. If a limit order is filled, it's only going to be filled at a specified limit price or better, but there's no assurance of execution.
Right, because we don't know that the price will ever get there.
Exactly. So we have a couple charts here. Let's go to the charts and explain it. Okay. We'll use the visual here.
All right.
So in our limit order chart, let's first recognize where's the market currently trading. That's our white line here. Okay. And so right now we can see, if we look over to the right, that this stock is currently trading at about $139 per share. Now, if you're in the market, you could choose to buy it or sell it at that price. Now, let's say that we had a limit buy. What does that mean? Well, that means if we're willing to buy, if this market falls down in price, cheaper for us, let's say that we have a target price point of $133 per share. Okay. Well, we could enter a limit buy order, even though it's only currently trading at $139, and say, I am willing to be a buyer of 100 shares of this stock if the price reaches $133.
Right. Once it gets down to that price, I think it's a deal at that point. I'm in then. And you could probably tell the system, 10 shares or X amount of dollars,
Yep.
either 10 shares or $10,000 is how much I want to buy when it does get down to that price.
Absolutely. And there's also a timeline on that. You can say, I want this order to be good for one market day. Or you could basically say this is good until filled, meaning you're willing to have that position as long as it takes. Could be several days, maybe even weeks before it gets to that price. There's other ones like good for 30 days. So
What's the most common one?
Typically good for one day.
One day.
Yeah, typically. If you're doing some sort of day trading, good until filled can be a little risky. It just depends on what your time horizon is. I mean, maybe you're a very patient trader, but you really believe in this company if it's at a price that you like.
I would say good until filled could be a little, as you said, risky because you're saying, hey, I want to buy it at this price based on everything I know about the stock right now.
Right.
There might be some additional information that comes out about that stock a week from now that you say, hey, I didn't want to buy it at that price had I known this about
Right, exactly.
the CEO or whatever.
Exactly, sure.
Okay.
Yep.
So
or it could be a really attractive stock that, hey, you want to get in at a low price, but it just, everyone else thinks it's attractive too, so it never gets down to that price that you want.
Gotcha.
So that's the risk there.
So that's a limit buy. So what's this limit sell on the red line that we're looking at?
So a limit sell, typically, that basically is saying that you are a willing seller if this price of this stock reaches a certain amount. This is often used when, let's say you already own the shares of the stock in question here,
right,
and you're willing to take profits if it reaches a certain level. So you've got, a target kind of profit margin kind of baked into your trade. Say, okay, at least in our chart here that we've got, if this stock that is currently trading at $139 per share reaches 142, now I'm willing to sell, and I'm going to take my profits.
Okay, very good. I'm happy with the gains that I've made. And again, you could own 100 shares, but you only want to sell 10 shares or whatnot at that particular point. And then you say, okay, I'll sell them at that point and pocket my gains.
That's right. Absolutely.
Okay. So that seems pretty easy to understand. Limit sells and limit buys. I think we're going to get into something a little bit more complex here. And these are stop orders.
Yep. So a stop order. Let's talk about the basics here.
Let's move over to this graph now.
Exactly. Yep. I'll move over to that graph here and we're going to pull it up here in a second. But a stop order is essentially an order to buy or sell a stock at the market price once that stock has traded through your specified price. If the stock reaches that stop price, whatever it is in your mind, then that order immediately becomes a market order and it goes live. Okay?
All right.
Kind of like a limit order, though. If the stock fails to reach your stop price, then the order isn't executed at all.
Right.
So let's take a look at the chart and see where this might be appropriate.
Okay.
It can be appropriate for a couple of things. Let's say that you're in a stock that has already risen a pretty good degree, and you think that market move might start to peter out.
Okay.
And so if it starts to roll over and begin to fall, you basically want to stop that on paper loss, and you want to sell at a certain price.
You want to cut your losses. Say, hey, if it gets down to this point, I'm out.
Yep. So let's go to our stop order chart here. Let's say we know this is the same chart, just with a couple things reversed here, Brice. So we know today the market price is 139.
Okay.
Okay. But suppose that we got into this stock way back when it was trading at 124 or 122.
All right.
Okay. And we've had a nice little rally. Well, I'm saying I'm going to stop my losses if this stock rolls over and it dips down to 133.
Okay.
At that point, I'm willing to sell because that's still a winning trade for you. If you got in at 122 or 124, yeah, currently it's at 139, but if it starts to fall down to 133, okay, I'm out. And at least I've made a profitable trade.
So sometimes I guess people could be setting that stop sell line as a percentage or a dollar amount off of what the current market price is.
Oh, absolutely.
Okay.
So a stop loss order or a stop sell in this example is really common when you've just opened a trade.
Okay.
Let's say we just got into this stock at 139, the current market price.
Right.
And we believe it's going to go up, but we're not quite sure. And if for whatever reason it starts to drop to 139, okay, we're going to stop our losses. That's the stop sell or the stop loss. That's where it comes from. And okay, we got in at 139, but we're going to get out if it drops below to 133. okay, we're going to take that small loss and move on with our day.
All right, so that's if somebody bought it at 139, but let's say a week later that price had gone up, and so they buy it at 139 and they set their immediate stop sell at 133.
Yep.
It wouldn't be unusual for, we check in on that same person a week later, that price has gone up to 145, so they probably increase their stop sell by a few dollars as well.
Yep, so you can basically raise your stop sells or stop loss trades as a winning trade or a winning stock continues to climb.
Okay,
absolutely.
Very good. So that one doesn't seem too complicated to me.
Yep.
I think I get that.
Yep.
Let's go for the granddaddy here.
Yeah.
Stop buy. Help me understand this one.
Okay, so a stop buy order. Essentially, admittedly, it's not used very often, but a stop buy order would be, what you're trying to stop here is, let's say you've got a red hot stock that just is taking off.
You own it.
You either you own it or you just want in on it at a certain price.
All right.
And so back to our example here, and you can see this stock that we're looking at has definitely taken off. Market price currently is 139, and you know what, Brice, if this thing continues to just rip roar upward, I want in at 142. I am no longer willing to let the market get away from me. So essentially a stop buy order is you're stopping the market getting away from you. Okay. That's one example of where it could be appropriate. There's a couple other examples where, if you're in the game of short selling stocks, where you might want to buy stocks at a higher price than they're currently trading at the market because you intend to essentially short sell them immediately thereafter.
Okay.
That's a little bit more of an advanced technique, but for the most part, at least for this, understanding that a stop buy is saying, I am no longer willing for the market to get away from me. Mm-hmm. I want to get in at a certain price. Going back to your original example there, let's say that we owned a stock and we had a pretty significant portion of it. Let's say that we had a $100,000 position and we got in at 139, but you know what? We're a big believer in that stock and we're willing to invest, $20,000 more, even if it climbs up to 142. I still think that this company's strong enough and it's just going to go on a tear. That could be an example where you would use a stop buy.
Okay. Yep. I think really what it is here is the title is a little misleading, at least in my book. A stop buy is really a start buy. This is when I want to start buying, not stop buying.
That is true.
So I think that perhaps is why it was a little hard for me to get my head around
you're
this.
Stopping the market price from getting away at a higher level.
Yes.
Yep, absolutely.
Okay.
Yep.
Very good. All right. So we've covered now market orders, limit orders, and stop orders. Exactly. There's a lot of different other types of orders out there. Sure. They just get much more complicated.
Absolutely.
Options trading and all of that.
We wanted to get just a little tip of the iceberg of what kind of, being a full-time trader would look like, the different orders that are used, just for folks out there who are curious and hopefully just to learn a little bit extra. So.
Very good. Well, that's going to cover it for this episode of The Vault. Really hope this was helpful for you and inspires you to decide whether or not you want to dip your hand into all these market orders, limit orders, and stop orders in the future and make your profits for yourself. It's a risky game out there, so know what you're doing. But that is going to cover it for this episode of The Vault. Feel free, again, to hit these like and subscribe buttons down below the screen if you want to catch future episodes of The Vault with Doug, Garrett, and myself. Remember, financial plans do not create themselves. I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault.